Stock markets around the world are fluctuating over heightened tensions between Russia and Ukraine. But a recent Barron's article suggests that the dip in stocks is going to be short-lived. Nicholas Jasinski wrote that piece and joins me now with more. Welcome, Nicholas. Thanks very much for being with us. So how is the Russia-Ukraine conflict impacting markets right now? And why do you believe this dip is only short-term?
Hi, Elaine. Thanks for having me on. So in the short term, this is just one more cause of uncertainty in what has already been a volatile period for markets and for investors. But history shows that the long-term impact on the market won't be significant, barring some sort of worst-case scenarios that we can all imagine. From a humanitarian standpoint, of course, it's a tragic situation for millions of people who could soon be living in a war zone. But for U.S. investors, the reality is that it's tough to draw a direct line from Ukraine to the S&P 500 or to the U.S. economy. It's a relatively small market for both exports and imports from the U.S. And like I mentioned, history shows that these types of geopolitical shocks, they tend to be short-term hits to the market. They introduce a little bit of volatility, but as long as there isn't a recession or other economic shock at the same time, like we saw after 9/11, then the long-term impact tends to be pretty minimal.
Well, how are other assets trading like gold, oil, and the Treasury note?
So it's certainly the impact on oil and gas is much greater. Russia is a major exporter of oil and gas to Europe and other parts of the world as well. And traders are clearly nervous that the situation in Ukraine will cause greater disruptions in supply. And oil and gas prices have been steadily rising since the start of the year. And that's one way in which you can have a second-order impact on stock valuations as well, and bonds, like you mentioned, because energy costs are, of course, a part of the consumer price index. And we have inflation already at 40-year highs, and the Fed is going to be raising rates to get ahead of that. So higher energy prices eventually find their way into inflation measures, and higher inflation means that we might have faster or larger interest rate hikes from the Fed, and that's impactful for stocks and bonds as well.
And as you know, there are concerns energy supplies could be disrupted if Russia were to invade Ukraine. So how might conflict impact already high gas prices here in the U.S.?
Well, oil and gas, it's a global market. So when there's higher prices in one part of the world, that tends to travel around the world as well. And a lot of, for example, here in New York, Con Edison customers saw higher gas bills for last month. So it's already something that we're feeling because traders are anticipating that there is going to be some sort of disruption. So the higher gas prices are here today.
So, Nicholas, what is it that you think small investors need to watch in the coming days or weeks?
I mean, I think the story for this year remains this big shift in monetary policy by central banks all around the world. And that's after 2 years of interest rates at zero, buying trillions of dollars of bonds and other assets. Central banks are tightening policy, and that means pressure on stock valuations. And it's this tug and pull between that pressure on stock multiples and earnings growth in what's still a pretty robust economy. So I think that's what investors should still be focused on and try to hold on through some of the volatility that all these headlines that we're seeing about Ukraine and Russia are gonna keep throwing these bombs at the market from day to day, but stay focused on the long term.
All right. Thank you very much, Nicholas Jasinski. Thanks for your insight.
Thank you.